So, welcome to today's presentation. My name is Peter Yusuf, Senior Market Analyst at IronFX. In front of your screens, you have goals for our chart. I have to note here that maybe with the exception of cryptos, the gold instrument presented the highest volatility. And we must say at this point that gold's price jumped, and it jumped at around $40. It was pretty impressive on Friday. Now, the rise of gold's price may be attributed to a weakening of the US dollar. However, we have to say here that the weakening of the dollar was not in line, at least regarding volume and price volatility, with gold's rise. So more or less, we may say here that the rise of gold was asymmetric if compared to USD's weakening. Now, there are a number of reasons, fundamental reasons, which tend to support the idea of gold rising. Definitely, weakening of the US dollar on Friday was one of them. However, I would be noting here the buzz around analysts for the possibility that a number of short positions on gold were covered with long positions, more or less pushing the precious metals price even higher. It's characteristic how the precious metal practically started out from 2042, which has now been turned into support line, and was able to breach even the 2075. It also has to be turned into support line. And definitely the movement forces us to make a recalibration of gold's support and resistance lines. Allow me to have a look here, drilling out to the daily chart. Okay, we could actually push the R2 a little bit higher and make it R1, and that would be in green, red at 2090. And still we would be necessitating a new record high level, and I'm going to be setting it, let's have a look at 2,200. Could be a little bit far-fetched. 180. In red. Okay, let's readjust our support and resistance lines. Definitely the R1, the S1 could go a little bit higher. I would like it to meet this peak here. And let's set the labels, starting with the R3, which is now being set at 2,180. The R2 at 2,135. The R1 at 2,090. The S1 at 2052. The S2 at 2014. And the S3 at 1972. Now, if we have a look at the daily chart always, as we have mentioned before, you can see how the rise of gold's price accelerated despite some stabilization. midweek last week, and is currently testing the 2090 resistance level. Now, the bullish outlook seems to be maintained. That's clear. I would like to insert here a word of caution, though. And I'm basing this caution practically on two facts. The first fact is that the price action of the RSI indicator has risen and surpassed the reading of 70, which, okay, definitely on the one hand tends to highlight the strong bullish sentiment of the market for gold. On the flip side, though, may also be implying that gold's price may have reached overbought levels and may be ripe for a correction lower. Similar signals are coming out of the Bollinger Bands as well, given that the price action, you can see how the price action broke the upper Bollinger Band. And that may more or less signal that once again, the market may have overstretched it a little bit to the upside, and that may more or less slow down the bulls, if not cause a correction lower. So the bullish outlook is there, but do not be surprised if you see gold's price correcting a bit lower. Should the bulls maintain control, I would expect gold's price to breach the 2090 resistance line, a level which was tested once, twice. And the next possible target for gold's price would be the R2 2135, which is a record high level. So practically, gold's price is already at pretty high levels, which may be providing some hesitation for gold bulls. It's something which we will have to wait and see how that plays out. I would be expecting to see an opening of the American session, which could prove to be quite interesting for gold traders as well. On the flip side, for a bearish outlook, that would be quite difficult. The price action of gold for a bearish outlook would have to retreat, break the 2052 support line, practically render back any gains it had made on Friday, breach the upward trend line, and start aiming for the 2014 support line. The breach of the upward trend line is crucial in the sense that it would be signaling that the job is not a mere correction, but the upward motion has been interrupted. And I'm quite conservative actually right now. So nevertheless, I would require for bearish outlook a breach of the upward trend line and the precious metals price to actually reach the 2014 support level. We're talking here about $70 down, which is actually, in my opinion, out of scope right now. So I tend to maintain the upward bias and expect the price action of gold to breach the R1 2090. On the other hand, the stabilization is also possible. Why? Because it would allow practically the Bollinger Bands to catch up and possibly the RSI indicator to correct a bit lower, allowing for some breathing space for the bulls to jump to higher highs later on. Okay, let's have a look at Euro USD as well. Euro USD, which tends to maintain a sideways motion, that's pretty clear. We remain biased to the sideways motion for the time being. Albeit we have to note that the price action is about to rise above the previous peak and may start aiming for the 1.0890. Note how the RSI indicator is slowly rising, while the price action has broken above both the 50 and the 200. That should be wrong. Definitely the orange line is the 200. Okay, and the green line is the 100. So let's switch that, make it 1500. So the price action is moving upwards at a faster pace than the average price action over both the 50, the 100, and the 20 moving average. And that's another bullish sign. While note how the price action actually tested the upper Bollinger Band during today's late European session. Always remember we're in the 4-hour chart of Euro USD. So I would expect the upward motion to be maintained for now. However, for a bullish outlook, I would require a higher peak than this one. So the price action has to breach the 1.0890. A mere rise above these peaks here, in my opinion, that's not enough for a bullish outlook, a clear-cut bullish outlook. I would require a breach of the R1. On the other hand, should the pair correct lower, yet respect the S1 1.0795, that would be implying more or less a continuation of the sideways motion, which has been in place practically since let's have a look, when it broke the upward trend line, since the 28th of February, that would be last Thursday. While for a bearish outlook, we would require the pair to drop, breach the S1 1.0795, a level which provided support once, twice, 3, 4, 5, 6 times. So that's pretty valid. And a possible breach below it, opening the gates practically for the 1.0765, and that's a mistake. Let me correct that. That would be the 1.07, sorry. There you go. Would be signaling exactly a possibility of a bearish outlook. Let's have a look at all the resistance support lines. Yep, they're correct. Okay, let's have a look now at USD/JPY, which has been in a very tight sideways motion. Now, USD/JPY, you can see how the price action of the pair is actually confined between the S149.60 and the R150.80. My opinion, that's pretty obvious of how the sideways motion is dominating the price action of USD/JPY. And at this point, I would expect actually the sideways motion to be maintained for the next 24 hours. And I'm citing here the fact also that the price action of RSI indicator below the 4-hour chart continues to run along the reading of 50, which tends to highlight a rather indecisive market. Now, on a fundamental level, if I was trading USD/JPY, I would be quite cautious tomorrow during the Asian session. You have two events which could be of substance for the JPY side of the pair. The first would be the fact that we're getting Tokyo CPI rates. They are more or less for February or for March. Let me check that out. In any case, they are expected to accelerate. And should they actually accelerate, that would allow practically the JPY side of the pair to strengthen, as that would support market expectations for a possible rate hike by BOJ in April. So that's an issue. On the other hand, yeah, they're for February and they're expected to accelerate from 1.6% year on year. And I'm talking about the core rate here to 2.5%. It's a substantial acceleration. And the second element I would be highlighting would be the statements which are planned to be made by BOJ Governor Weda. Now, we all know about JPY's dual nature as a safe haven and a national currency at the same time. However, currently what seems to be moving the Japanese yen would be primarily BOJ's intentions and the possibility of the start of a normalization of the bank's monetary policy. It's characteristic that despite, and that's more obvious if we go to the daily chart, you can see that, okay, there was a weakening of the pair on Thursday, but on Friday, despite the US dollar actually weakening against its counterparts, that was not the case against JPY. JPY was even weaker. So more or less, I would expect BOJ Governor Weather to reiterate his comments he made on Friday morning that it's too early to start talking about a rate hike, and that could actually weaken JPY. So we may be getting some conflicting messages regarding the JPY side of the pair during tomorrow's Asian session, which may increase volatility somewhat. For the time being, on a technical level, once we have mentioned our bias for the sideways motion to continue still stands. For a bullish outlook, I would require a clear break of the 150.80 and the price action to start aiming for the 151.90. Mind you that the 151.90 is practically a 30-year high of the pair, if not more. Allow me to drill into the daily chart here once again. Let's have a look. You can see the touch here. Let's drill into the monthly chart. And it doesn't allow us to go back. However, we could always download from the history center USD JPY monthly download. Okay. And it's going to be a slow process. In any case, on the other hand, we have to note here the US dollar's fundamentals, and they're quite interesting as well, in the sense that we had a weakening of the US dollar, and that was primarily due to two factors. The first factor were the adverse financial data, which were released on Friday's American session. We had the ISM manufacturing PMI figure, which came in quite lower than what was expected. It came out at around 47. It was expected to remain near 49. It did not. It dropped, and it highlighted deeper contraction of economic activity in the US manufacturing sector. On the demand side of the US economy, we had the release of the final University of Michigan consumer sentiment. That was also February. It came out also lower than the preliminary release, and that signaled more or less more pessimism among US consumers about the outlook of the US economy, which in turn could hinder retail sales somewhat and the rise of the GDP rate. So those two data, or those two financial releases, were already a minus and had exercised bearish pressures on the US dollar. On the other hand, I would be noting that at the monetary policy level, the market seems to be increasingly expecting that the Fed will proceed with a rate cut as early as June. And it's characteristic that you have already Fed funds futures implying that the bank or the market is expecting the bank to cut rates by 25 basis points at a percentage of 56%. And at this point, I would be noting here, so that's done. I would be noting here that also the market expects by 15% that the bank will be cutting rates by 50 basis points. So in total, you have market expectations being priced in that the bank will proceed with a rate cut in the June meeting by 70%. So more or less a rate cut, whether that's going to be at 25 basis points or 50 basis points, the latter being more distance, or quite more distance. But a rate cut is quite plausible, or at least the market expects that it's quite plausible. And that would be, in my opinion, highlighting the dovish expectations of the market, which weighed also on the greenback on Friday's afternoon. So more or less, I see that the main causes of USD's weakening on Friday's American session were A, the adverse financial releases, B, the increased dovish expectations of the market. Mind you that US yields also dropped in Friday's American session. That was also another indicative sign that interest rates are expected to drop. Now, you can see how the price action hasn't reached the R3, and that was since, let's have a look, June 1990. So the R3, if we drill back to the 4-hour chart, daily chart, sorry, here you go. Now the R3 is already practically at the record high levels. It's actually at the 33 high level, but in my opinion, 30 years ago renders any resistance lines as immaterial. What matters right now is practically how the volatility of the pair is going to be moving upwards or not. Back to the 4-hour chart, readjusting it. Let's readjust the labels as well. Now we've covered the bullish side. For a bearish outlook, the price action has to breach the first support line, which is the 149.60, and start aiming for the S247.75. Nothing less. Let's have a look at GBP USD. Now, GBP USD has been moving in a sideways motion. That's pretty much clear. I would, though, readjust the resistance support lines. And allow me to actually narrow the distance between the resistance lines and the support lines. I would be bringing down the R3 all the way here. This seems to be a pretty valid resistance line given that the price action had a peak here. And in my opinion, that's a mark which is going to be decisive regarding the upward or downward motion, as we should readjust also the lower S1. Okay, let's correct the labels. We have a new R1, the R2 remains the same, and the R3. And that's set at 1.2615. The R1 is being set at 1.27. And the R2 is being set at 1.2775. Let me readjust that. Lock it in. And the R3 is now being placed at 1.2870. Readjusting the chart, magnifying it so we have more detail. It's crucial that you get a clear view with the moment that you open the chart. The S2 at 1.2535 remains unchanged, and the S3 at 1.2445 also remains unchanged. So for the time being, we tend to maintain a bias for the sideways motion between the 1.27 and the 1.2615. We're talking about an 85 pips corridor, which more or less tends to maintain the main price action of the pair. And at this point, allow me to highlight it by inserting a shape here, rectangle. So you can see the limitations in the orange rectangle as well, to the upside and to the downside. For a bullish outlook, we would require the price action to breach above the 1.27 resistance line and start aiming for the 1.2775. Overall, pound traders have few financial releases today, not only today, during the week actually. And maybe with the exception of tomorrow's final services PMI figure, which could be of some interest for pound traders, I would expect fundamentals to lead the pound. Should the US dollar on the other side continue its weakening, that would allow more or less the bullish price action to be maintained, possibly pushing the price action of cable above the R1, the 1.27, and start aiming for the 1.2775. For the time being, the R1 remains the upper boundary of the current sideways motion. On the other hand, should the bears take over, we may see the price action dropping, breaching the 1.2615 support line, and start aiming for the 1.2535 support level, a level which provided support once, twice here, so that's pretty obvious that it's a support line. And in my opinion, actually it's a barrier. Let's have a look at USD CAD. By the way, feel free to add any trading instruments you would like to have a look at. I'm not seeing them, but if it comes into the chat box, our associates will let us know. And if we have time, we could look at it today. If not, we could always look at it tomorrow. Now, the USD CAD is in a sideways motion. That's pretty obvious. The price action is revolving practically around the 1.3570. It used to be a support line. Now the price action has moved slightly below it. The big question here is whether we could push upwards slightly the S1 and turn it into a resistance line. However, that would also imply a pushing up of the R1. Let's drill out, move to the daily chart. Okay. Definitely the R1 could go a little bit upwards. And we would now require a new S3. Yep. At 1.36 in red. Drawing all the way down. Green. Okay, let's readjust the levels. This is the daily chart. Let's not forget it. If you want to drill into the 4 chart, could also do that. Yeah, that's much better. So we have the R3 at 1.3830, the R2 at 1.3695, The R1 is being set at 1.36. You can see how the level was tested once, twice, 3 times, so that's pretty valid. Starting with the S1 at 1.3450, the S2 at 1.3320, and the S3 at 1.3160. Let's lock the prices in. We note that the price actions sideways motion is better described by this rectangle in orange. You can see it right now. It's actually pretty obvious that the R1 is the upper boundary while the S1 is the lower boundary of the sideways motion. The RSI indicator is running just above the reading of 50, implying also a rather indecisive market. Right now it's at 52.03. So I would expect the sideways motion to be maintained for the time being just below the R1 1.36. For a possible bullish outlook, I would require the price action to breach the 1.36 and start aiming for the 1.3695. But note how the Bollinger Bands have narrowed, exactly highlighting the low volatility which characterizes the pair's price action. At the same time, I would be noting here that for a bearish outlook, which is even more difficult to achieve, we would require the price action to drop, and definitely we would require a breach of the S1 1.3450, paving the way practically for the 1.3320. Nothing less. Let's have a look at AUD USD. Should be similar but in reverse. Actually, it's not. We have quite an interesting volatility here in the sense that there was a downward motion, yet the downward motion seems to have been interrupted on Friday's American session as AUD USD benefited from the weakening of the US dollar. For the time being, the 0.6520 was broken, so it turns from a resistance line to support line, and that forces us to have a look for a new ultimate resistance level. Unlocking the chart, this is pretty obvious. You can 1, 2, 3, 4. I'm keeping that as a new ultimate resistance level in red. That would be the 0.6730. Let's readjust the chart and correct the labels. Starting with the R3 at 0.6730 as mentioned, the R2 at 0.6655, the R1 at 0.6575, the S1 at 0.6520, the S2 at 0.6440, and the S3 at 0.6350. Now the RSI indicator is running along the reading of 50, implying a rather indecisive market. It's currently at 51.9, also pretty near to the reading of 50, which could allow the sideways motion to continue. Similar signals are being sent out also from the Bollinger Bands, which have narrowed, implying more or less volatility for the pair. So for the time being, I wouldn't be surprised to see the sideways motion being maintained, with the price action possibly revolving around the 0.6520 level. For a bullish outlook, I would require the pair to rise, breach the R1 0.6575, used to be a former support line, and start aiming for the 0.6655. On the flip side, for a bearish outlook, now the bar is pretty high here for a bearish outlook. We would require the pair to drop, breach the S1 0.6520, but I would also require a breach of the 0.6440, or at least a testing of it, like here, before it moves even lower. In that case, for a bearish outlook, possibly the RSI indicator will have a downward inclination towards the reading of 30, and that should be more or less clear. Let's have a look also at WTI. Now, WTI is a very interesting trading instrument in the sense that, okay, the resistance line has been breached, and that turns into support line. But in my opinion, the main element here is that we are talking about, and allow me to drill into the daily chart for this. It seems as if the price action is moving in a channel it's pretty wide, but it's quite interesting to see whether that's going to be verified or not. Back to the forward chart. Yeah, it should be narrowed a bit. Yeah, that's it. Now, let's go hunting for a new resistance level. Unlocking the chart. At 89.50. You can see the peak which the resistance line is resting upon. Let's readjust it and correct the labels. First resistance line being set at $82. And first support line now being set at 78.30. Used to be a resistance line, but now, given that the price action has moved above it, has been turned into support line. Second support line at 75.65. And third support line at 71.55. Once again, we tend to maintain a bullish outlook for the commodities price action, given the upward channel, in my opinion. And at this point, I would be noting that there have been higher peaks in a row and higher troughs, especially lately. I would expect a correction lower before the next peak, which could be set to start aiming for the 82 resistance line. Although we have to note here that volatility in today's start of the week seems to be quite low. Yet I would expect that we may see more or less some increased volatility tomorrow and during Wednesday's American session, as we will be getting in tomorrow's early Asian, late American, the AP weekly crude oil inventories, and in Wednesday we get the EIA crude oil inventories. And should they show that the US oil market remains, I would say, pretty loose, at least with a slack, should oil inventories continue to rise, then we may see that having an adverse effect on our prices. That should sum it up from all of us here at IronFX. Best wishes for solid trading.
Everyone, my name is Emily. Today we will look at what influences the price movements of major currency pairs. Currency pairs are influenced by geopolitical events, central banks' interest rate decisions, and macroeconomic data. For example, the Federal Reserve, the central bank of the US, maintains financial stability by increasing or decreasing the discount rate. The Fed sets target interest rates at which banks lend to each other overnight, but it also sets the discount rate, the interest rate at which banks can borrow from the central bank. If the Fed raises interest rates, it increases the cost of borrowing to slow down the economy. On the contrary, in order to stimulate the economy, the Fed lowers rates, making borrowing cheaper and encouraging spending on credit and investment. Economic releases such as major economies, CPI data, non-farm payrolls, gross domestic product, retail sales, purchasing managers, index, and others can influence the value of a currency and create volatility. Politics, trade wars, elections, corruption scandals, and changes in policies can create political tensions which can influence the forex market. For example, Brexit and British or American elections have been major events in recent years which have affected both the political and financial spheres. Traders who are new to forex trading tend to choose liquid currency pairs like the euro against the USD or the USD against the JPY. They also spend a significant time on researching and learning the forex market and the currency pairs they are interested in by analyzing technical charts and monitoring economic data. Choosing the right forex trading strategy, cultivating discipline, and eliminating emotion are also important. Depending on your schedule and lifestyle, you can also choose the right time to trade, which will also determine your trading. You can choose from swing trading, day trading, or scalping. Whatever currency pair you choose, or what style you decide to follow, ensure you have a solid education and learn as much as you can about the market you want to trade. Thank you so much for watching us, guys. Bye-bye.
So, hi everyone, welcome to our Trade Management Series webinar. So, this is brought to you by Everest Fortune Group in collaboration with IronFX. So, today's first part of our series will be on scalping. Okay, before we get started, just a risk warning. Okay, Michael is a scalper most of the time. That's cool. I do like scalping as well. If I don't have that much time to sit in front of the computer, I think it's a good strategy as well. So we'll go through three powerful scalping strategies at the end of the webinar. So you guys can keep a lookout for that. Okay, so a risk warning, our products are traded on margin and carry a high level of risk, and it's possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risks involved. So disclaimer, the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the authors, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein, and redistribution of the material is strictly prohibited. Okay, so here's our agenda. We'll just do a brief intro to scalping for those of you guys who aren't familiar with it. And then we'll take a look at Fibonacci confluence and where you should place your stop loss and take profit. And then stay tuned to the end to where we'll go through three powerful scalping strategies. So I'm your host for today. I'm Melanie. I'm an investment analyst from Everest Fortune Group, who were finalists for Best FX and Equity Research in the years 2019 to 2021. Okay. And if you guys were curious, you can feel free to connect with me on LinkedIn as well. It's just my name. Okay. So what is scalping? So it's a fast-paced, exciting, and mind-rattling all at once. So basically it's where you take trades for short time periods. So you grab very small amount of pips and you risk very small amount of pips as well. So you're basically taking advantage of market volatility in this case. And the time frame, if you guys were wondering, for scalping is normally on the shorter side, just so that you can catch all of the market volatility, the market movements. So it's briefly, we think that 1 minute to 5 minutes is a little bit too short. So because the time frame is so small, it can get really, your charts can get really noisy, and it might be a little bit difficult to catch all of the movements and conduct your analysis because of the constant movements. So we like to stick with 15 minutes to about 1 hour for scalping. Okay, so why scalp? There are known unknowns. Okay, so what we mean by this is a good example would be if the NFP is coming out tomorrow, for example. You know that the event is coming, but the outcome is unknown. So these events can really mess up a trade. So in this case, you would use scalping so that you can avoid any um, known unknowns, basically. Okay, and locus of control. So let's use weather forecast, for example. So if there's a 1 hour forecast versus a 1 week forecast, you are likely to have more control over what's happening in the next 1 hour versus over the next 1 week. And new opportunities every time you open the chart. So market moves really fast on the M30 and H1. So there are new patterns every couple of hours. Okay, so how much time do you need to scalp? Time commitment wise, you basically have to find the trade and set the trade management. We'll talk a little bit about stop loss techniques and stuff like that later on. But that's basically all you need to do. Set the trade, make sure that your risk management strategies are intact, and that's it, you're done. And then you just have to review it every few hours. So the holding time is typically from a few seconds to a few hours, depending on your own strategy. So our recommended time to trade, or rather the different amounts of time that you have to put in, will be 1 hour in the morning, an hour in the afternoon, and an hour in the evening. So it's not too time consuming, and it's important to have proper risk management so that you don't need to monitor the trades all the way. Okay, so this talks about your trading stop loss, the different stop loss techniques, which we will briefly talk about later on in our slides. How much leverage do you need to scalp? So this is typically quite a high leverage strategy. So it's about 1 to 100 onwards. And you normally would use low spread pairs. How much capital do you need to scalp? So a good amount to start with is 250. That's just our recommended amount. Of course, it's completely up to you. Decent leverage of at least 1 to 100 is preferred, but not necessary. So if we're talking about what exactly is leverage, so if we take, for example, a trader who deposits $1,000, so they can use $100,000 with a 100 to 1 leverage in the market. So this can greatly magnify your returns, but also your losses. And this is considered acceptable as long as only 1% or less of the trader's capital is risked on each trade. So what this means is that with an account size of maybe $1,000, right? Only $10, or which is 1% of 1,000, should be risked on each trade. So while this is difficult in practice, traders should avoid the temptation of trying to turn their 1,000 into 2,000 quickly. Okay, so yeah, so if you can do it with $250, then you can do it with 2,500 and 25,000. But definitely don't rush into scaling up. Okay, now let's get into the 3 powerful scalping strategies first. Okay, so firstly, we have the horizontal pullback strategy. So if you guys were here for our recent support and resistance series on our webinars, yeah, this would be familiar with you. Next would be our Fibonacci retracement strategy. So it's pretty straightforward. You're basically using Fibonacci retracement to see where prices will retrace towards. And lastly, we have the Nike tick strategy, or what we call Fibonacci extensions. So let's get into these now. Okay, we're going to start with horizontal pullback strategy. So a horizontal pullback basically means that we are expecting price to pull back or retrace back to that level. So in this example, we see that we have a multiple swing high resistance, this red area. Okay, we have 3 swing highs that all line up along the same area. And then price surpasses this resistance. So it breaks out of it. And since it's breaking out of it, we are expecting price to return back to that level. If you're wondering why we can expect price to return to this level, it's because of this multiple swing high resistance. So basically, the more number of swing highs or swing lows, if we're talking about support, if we have more levels that line, more swings that line up in the same area, price is likely to return and respect that area again. Okay? So in this case, since it's a resistance at first, we are now expecting it to become a support. So from from a resistance. Once price surpasses it, now we call this a pullback support level. Okay, if we are looking at a multiple swing low support, same thing, when price breaks past the support level, we're expecting price to retrace back to that same level. Okay, in this case, we are calling it a resistance. Okay, let me know in the chat if it's a little bit confusing. Okay, but here's a couple more examples. So the key basically to scalping is making sure that you have a bunch of indicators and a bunch of graphical analysis that all supports your analysis. So if in this case we have price moving below the Ichimoku cloud, so that's a bearish signal. Okay, and price has also broken out of this swing low support. Okay, so we're expecting it to return back to that level. And you can see that's exactly what it did here. Okay. Next, let's talk about the Fibonacci retracement strategy. So these are, firstly, this is an example of an insignificant swing. So just a reminder that these swings should not be used as Fibonacci points. Okay, because the swing highs and the swing lows are too insignificant. Instead, this is what you should be looking for. Really clear troughs and peaks and very clear market movement. So this forms the basis of all starting, middle, and ending points when we're using Fibonacci levels. Okay, so you shouldn't pick swing highs and those that are not significant, meaning that they need to have a relatively big move before or after it. So as a rule of thumb, you can use at least 15 bars before or after to see if they are really significant swings or not. Okay. Another reminder, okay, when you're drawing Fibonacci retracements, projections, extensions, or expansions, whichever you are doing, there's one important rule that you have to follow, and it's that your Fibonacci line must follow price structure. So your trend line can deviate from structure, but not by too much. So if you look at this example here, you can see that price doesn't really follow price structure over here. Okay, so this is what we've drawn is the shape of the price, and our Fibonacci just cuts through the shape entirely. So the trend line deviates from price structure by too much in this case. Okay. Next is our strategy. So the tool we're using here is Fibonacci retracement, which you can get from, it's the same tool that's on TradingView as well as MT4. So Fibonacci retracement percentage, excuse me. So for the percentages that we use for retracement, we use mainly the 5. So it's 23.6, 38.2, 50%, 61.8, as well as 78.6. So those are the levels that we use for Fibonacci retracement. Okay, so let's do a bit of a recap first. When you're picking the starting point, so basically your entry or your support or resistance levels, there are some rules that you have to follow. Firstly, we want to check if there's a swing high or low, pullback, or overlap level. So we talked about pullback already. Overlap, if you weren't here for our support and resistance, overlap basically means that there is a swing low as well as a swing high that are at the same level. Okay, that's what we call an overlap. So secondly, we want to make sure that our starting point goes back as far as possible. And you want to make sure that it doesn't intersect too many bodies of candlesticks, but the wicks are fine. So you see in this case, it's just the wicks, so it's an okay thumb. But we are preferably looking for really significant swings like over here. Okay, another example here. We're cutting too many bodies of candlesticks over here, which is why it's not preferred. If you look at the green thumbs, we have really nice multiple swing highs that line up nicely, as well as overlap levels once the swing low touches that same level. Okay, and we see here as well another swing high here. Okay, once again, cutting too many bodies of candlesticks over here, which is what we want to avoid. So in this case, in order to rectify the situation, you can actually just stop your support level over here. So it's a support level because price has already surpassed this resistance, thus making it a pullback support because we're expecting price to pull back or retrace back to this level. Okay, so we talked about the pullback already, so I'm just gonna really quickly skim through this. I'm just gonna show you guys the GIFs. Yeah, and show you guys how we look for pullback support and resistance levels. Okay, so here we are making use of two levels, or rather two Fibonacci trend lines. Okay, we have this really long one here and one small one here. And then we highlighted the area where we are expecting price to retrace off of. Okay, so the 61.8 and the 38.2 that we see here lines up nicely with this swing low. Okay, so a pro tip is that when a pullback support level lines up with a Fibonacci level, in this case we have two Fibonacci levels, so it's a very powerful level. Okay, because for this webinar we are focusing more on scalping strategies, so the time frames that we're looking at are on the shorter side. So briefly from 15 is like the lowest that we go, 15 to about 1 hour, preferably 30 to 1 hour for scalping. But this strategy can be used for pretty much anything, even if you are a day trader as well. Okay, but yeah, for this webinar, mainly focusing on the shorter time frames. Okay, we looked at these examples earlier. No worries, friend. So we have another example here, the pullback resistance as well. So you can see that we have a significant swing low here, right? And price has surpassed this level. So once price has surpassed it, it then becomes a resistance because we're expecting price to pull back to this level. And you can see that's exactly what it did. If we move on to overlap. So I already briefly mentioned it earlier, but yeah, this GIF basically tells you what an overlap is. It's when there are bulls and bears that are respecting that area, which is why it's an important point to take note of. Similarly, if overlap areas line up with other elements like Fibonacci or graphical elements, then it'll make it even stronger. Okay. Here's another example. I think you guys have kind of gotten it by now. But just another example in case you weren't clear. So this is a pullback resistance first, okay, because price has surpassed the swing low level. So it's past it, we're expecting price to pull back to it. And once price pulls back to it, as we see in this GIF, and reverses off of it, it then becomes an overlap level instead. So the difference is that the difference between pullback and overlap is that once price reverses off of the level, then it becomes an overlap level. Whereas for pullback, we're just looking for price to surpass it. Okay, so now that we know what overlap and pullback levels are, we can combine them to find strong resistance and support levels. So, sorry about the text, but here we have a big swing high resistance level. Okay, price surpasses this level and becomes a pullback support. So we expect price to pull back or retrace to this level, the same rate level here. Okay, and in the green arrows, we see price retrace this level and bounce off of it perfectly. Once price bounces off the pullback support, it then becomes an overlap support level. Okay. Combination of pullback and overlap, same concept over here. We have two swing high resistance and then a pullback support once price surpasses it. And then we can see price actually respected the area twice in this case. And then once price bounces off of it, it then becomes an overlap support. So actually, even after the first bounce off of this level, it's already an overlap support. Okay, but we normally when it happens once, you can expect it to happen again. Okay, another example here. In this case, we have prices respecting this 33420 level many times. Okay, with swing low supports, then a pullback resistance, and then a pullback to our resistance 3 times, and then a pullback support, and then back to our support level. Okay. Here's another example. Okay, we have this double swing low support. Price breaks out of it. Okay, we're expecting price to retrace back, but we also have a Fibonacci retracement. You see here 61.8 that lines up with that same level. We also have this 100%, this bigger Fibonacci level here with a 50% Fibonacci level that lines up with the same area. Okay, so this makes it a confluence area, which basically means that you have multiple Fibonacci levels that line up with the same area. Okay, so the reason why that's important is because price is always more likely to be attracted to these areas of confluence. And you can see over here that price was attracted to this area, okay, and then we're expecting it to bounce off again. Okay, like we see over here. Okay, so like I mentioned earlier, we typically want to try and use graphical techniques, indicators, different kinds of indicators basically to support your analysis. Okay, here we see that we might have a descending trend line, but you guys know that a valid descending trend line, you need 3 significant touches because 2 is quite common, okay? But we have price moving below the Ichimoku cloud, okay, but it looks like it's breaking out. We also have this almost descending trend line here. Okay, and we also have a Fibonacci retracement where 38.2 lines up with our trend line over here. Okay, And we're also making use of stochastic in this case, where we see that we have 3 swing highs that all line up together. So what this is called is a hidden resistance level. Okay, which basically tells us that price is likely to drop again, like we see over here. Okay, we see it happen twice. Price is making a lower high. Okay, but then over here on our stochastic, it's the same resistance level. So we can expect it to happen here as well. Okay, any questions about this? Okay, all good. Let's move on. So this is our third strategy, which is the Nike tick strategy. So it also makes use of the Fibonacci retracement tool. Okay, but instead we are using the levels that are more than 100%. So not included here is the 161.8 level as well. So we use 127.2, but we also use 161.8. And this is basically how you use it. Okay, so you have a starting point and an ending point, which is where you draw your Fibonacci trend line. Okay, and the shape that we're looking out for is basically like a Nike tick. So you have you want to make sure that the tail of your tick surpasses 100% of the starting point. Okay. Yeah, and then you see you're projecting where price will reverse off of. So in this case, price reversed off of the 161.8, and then we expected a reversal here. Maybe I'll just show you guys like where you guys can find this on our website. Okay, so you can find it over here. This is just the forexarmy.com. Maybe I'll just pop it into the chat. The Okay, so we have a bunch of trading guides and tools as well. So the tools are mainly for MT4. Just a bunch of indicators, free indicators for you guys to download. Okay. Yeah, support resistance guide and how to draw Fibonacci retracement correctly. So if after this you are still a little bit confused, you can go ahead and look at the extensions. So the extensions is basically what I'm referring to now, the Nike ticks. Okay. Retracements are really basic Fibonacci levels that are important as well to know how to use. Okay, so we have the clear market structures. You can see what to look out for. Yeah, you can go and explore this on your own along with the different confluence areas. Okay, and we'll talk a little bit about this towards the end of our webinar today as well. But yeah, if after this you're a little confused, you can go ahead and check the Forex Army out. Okay, so another example here of a Fibonacci extension. Here it's pretty small. Okay, we have a really small tick here. So you can see the hit from the 100% to the 0%. That's where I've drawn the trend line. Okay, so I've drawn the trend line and then I'm projecting where it goes. So I see that firstly, I have a swing high resistance here. Okay, so this is where I'm projecting price to go towards, but I see that it's also in line with a 127.2% Fibonacci extension. Okay, so it makes it a significant level. like you can see over here. Hi, Azif. Okay. Yeah, so this is the shape that you want to be looking for basically, with the head of the tick like this. And you can only use this technique once price has surpassed more than 100%. Okay, but the shape is like a Nike tick. In this case, I'm showing you guys an example of an inverted Nike tick. So the shape that we're looking for, same thing, we're looking for the head to be shorter than the tail. So the tail has to surpass 100%. Same idea, completely the same. It's just that it's upside down. Okay. In this case, we see that price has surpassed the 127.2%. Okay, so we are expecting price, or rather we're projecting where price will go towards. And in this case, we have price, we have a swing low support that lines up with the 161.8% Fibonacci extension. And you can see that price is reversing off of this level. Okay, so here's how it works, or what we are looking out for when we are using this technique or this strategy. Okay, so we're watching for the reactions off of the 127.2 and 161.8. We're expecting it to reverse off. That's basically what we are doing with this strategy. Okay, notice how we only go in with the Fibonacci extension after price breaks out of the 100% level. Okay, let's move on. So here's another example of the Nike Tick strategy. So the time frames that we recommend for this are 30 minutes, 1 hour, and 4 hours. The entry criteria is that once price breaks out of the 127.2%, stop loss level, okay, these are just recommended areas. So you don't have to follow these closely because charts are completely different. Okay, I don't think you guys can find a chart that looks exactly like this over here. So these are just our recommended areas for you to reference. Okay, so our idea in validation level is the 138.2. Break even is 11% of the recent move. 50% take profit is also 11% of the recent move. Full take profit, 22% of the recent move. And then for bonus, we will go in with other Fibonacci techniques like retracement, expansion, projection, and also support and resistance, like we previously mentioned. You're going with your pullback as well as your overlap levels. Okay, so this really just for your reference. Okay, it's not like you really have to stick to these levels. It's just if you're starting out and you don't know where to place your levels, you can just follow this guide. Okay, so here is the long example. Here we have two Fibonacci techniques that we're using. Okay, firstly, it's a little bit hard to see, but we are firstly using a Nike tick. Okay, let me show you guys where the Nike tick is from here to here. Okay, and then we see price surpass the 100%. And then we see the 127.2%, or it looks like price is approaching it here. Okay, and then we go in with our projection. So our projection is from here. Projection uses 3 points, okay? So the starting point here middle point here, and ending point here. Okay, and for projections, we use 3 levels, 61.8, 78.6, and 100%. So we see here that the 61.8 lines up with the 127.2 at this level here. Okay, so we can see that price reacted off of it nicely and shot back up. Okay, maybe another technique that I just want to briefly mention is our Fibonacci expansion. So for expansions, we use, let me try and find it. We use the negative levels. Okay, we use the negative levels, minus 27.2 and minus 61.8. So for this, we look for the flash kind of shape like you can see here. And we can often use this Fibonacci expansion with your projection levels. So like I mentioned, the 3 points. The 3 points is your projection, and we normally can use that with the negative levels. So you can see here, the negative levels, we have minus 27.2 and minus 61.8. And you can see how price reacted off of the minus 61.8 really nicely. Okay, now we're going to talk a bit about trade management with Confluence. Okay, so a good habit is to place your stop loss beyond a key Fibonacci confluence area. And the reason for this is because more often than not, price is attracted to areas of Fibonacci confluence, like we mentioned earlier. So if your stop loss is right before it instead of beyond it, you will likely get stopped out before the market reverses. Okay, so this is one of the reasons why people wonder why they get stopped right out before market starts to reverse, and then they start to complain about stop hunting. Take profit, on the other hand, you want to place it before a major confluence area. So when price reaches the Fibonacci confluence area, there's a high chance that it won't be able to go beyond it because obviously we're expecting it to reverse. So instead of it reaching your profit target, it's likely to reverse back to your entry instead, or maybe even to your stop loss. Okay, so and then people will complain that the market is being manipulated because they missed their take profit by 1 pip. So here's an example of how you can place your stop loss and take profit, just to maximize your wins and minimize your losses. This is also on the forexarmy.com website, so you can go ahead and take a look after this webinar. Okay, Fibonacci confluence. So multiple Fibonacci retracement lines up together, so we know that this is what makes a proper Fibonacci confluence, and the example is over here. Okay, we have minus 27% Fibonacci expansion, as well as the 161.8 Fibonacci extension that all line up nicely here. Okay, so maybe just to break it down for you guys, the minus 27% Fibonacci expansion, we're looking for flash or lightning bolt kind of shape. So you can see that over here. Fibonacci projection, similarly, we are also looking for a flash shape. That's why I said these two can likely be used together normally. Okay, so you can also see it, see the lightning bolt shape. And then the 161.8 Fibonacci extension, this is our Nike tick strategy. You can see that the Nike tick is inverted in this case. Okay. Yeah, and you can see price bounced off of this level. Another example here, we have the 127.2% Fibonacci extension, right? So this is the extension, and it lines up with the 61.8% Fibonacci projection. So the 3 points over here. Another example, 100% Fibonacci projection. So you can see the 3 points once again is your projection. I think you guys can see the lightning bolt shape here. And then we use a 127.2% Fibonacci extension. So you can see the Nike tick shape. So what we are looking for is basically levels that kind of look like this. So as long as you have two levels that line up nicely. Okay, so we're combining Fibonacci methods again. In this example, Fibonacci expansion. So you can see the lightning bolt shape here. And we have a minus 61.8% and the 161.8% Nike tick. So you can see the tick here. Okay, and we are projecting it to reverse off of this confluence area here. Okay, so we would expect it, or rather we would project it to reverse off of the higher area, obviously only when price breaks out of this level here, which is why it's good for scalping, because then you can take these small movements pretty easily. Okay, another example here. Okay, the minus 27.2% Fibonacci expansion. This is once again the lightning bolt shape. You can see it really clearly here in this case. And then the 100% Fibonacci projection, also lightning bolt shape. And then the 127.2% is the Nike tick shape. So you can see it. It's inverted in this case, okay? And all of these three levels line up and we see price reverse off of this area. So it's attracted to these areas, but it's not likely to go beyond it. So it'll be attracted to it, it'll test this level, and then it'll reverse off. That's the kind of movement that we're looking for here. Okay. If we look at dynamic take profit and stop loss placement, okay, your swing high would be your stop loss in this case because we're expecting price to hit towards our take profit. So we're going in for a sell in this case. Okay, so take profit is your swing low resistance here. Entry is at this swing low support that's turned into a pullback resistance level. Okay, and this level is also in line with the 78.6% Fibonacci retracement. So price hits our entry really nicely and reverses off of it and hits towards our take profit. Okay. Another example here. This is the same example, sorry. But in this case, I'm showing you guys that we have another Fibonacci retracement. No, this is a projection, sorry. So we have a projection here with a 78.6% that lines up nicely with our take profit. Okay. And then we see price just touched our take profit before reversing off of it. So this is why it's so important for you to know where to place your take profits and stop losses. Okay, because you can see here, it'll drop and then reverse off of it really quickly. So you have to be able to catch that touch before price reverses. And you can see it's really good that it touched nicely because it went straight to your stop loss after that. Another example here. Okay, we have price breaking out of the descending trend line. So since it's breaking out of it, it's giving us a bullish signal. And then we have this entry level we have our entry level here, which is a significant level. You can see the number of times that price has tested it. And then you can see that we have a lot of Fibonacci levels that line up nicely. Okay, we have the minus 27.2 Fibonacci expansion, 127.2 Fibonacci extension as well. Okay, and these all line up with this level here, which we then make our take profit. So if I had placed my take profit above the confluence area, price actually reached it and reversed off of it. So it would have missed my take profit by a few pips. And it would have hit it straight to my stop loss. Okay, whereas if I had placed my take profit below the confluence area, price hits our take profit nicely before reversing back down. Okay. Okay, that's it for my slides. Let me know if you guys have any questions. Maybe just to summarize, the three scalping strategies that we went through today, okay, were the Nike tick, which is the last one that we went through, and then the retracement as well as the pullback. So basically, you can use all three together, and that's the best strategy, is to combine all and form a confluence area so that you know which areas to look out for, and of course, know where to place your take profit and stop loss levels as well. Okay? Once again, if you have any questions after this webinar, feel free to check out forexarmy.com. Most of the information is there. How do we access previous sessions? I'm not sure if it's on YouTube. I think you can check YouTube first, the IronFX YouTube. But if it's not there, you can email IronFX. Okay, thanks so much, Wayne. Hope you learned something from this. Yeah, if you guys don't have questions, feel free to leave the session. Have a great rest of your week, and I will see you guys next week for our second part of this trade management series. And you can find me on LinkedIn if you want. Thanks, friend. See you guys next week. Bye, everyone. Thank you.